Good evening, everyone. This program is being sponsored by Wilkin Guttenplan in conjunction with FLICA. And I'm from Wilkin Guttenplan. I'm Ed Guttenplan. Also with her is Jules Frankel. Jules Frankel is a partner with the firm and also heads up our New Jersey CIRA practice, condo practice, and co-op practice. So Jules is here as a lovely hostess. So we thank you for coming as well, Jules. We thank the Colony for making the space available and for their hospitality. For many of you who have other board members you might want to share this information with, we will have, this program is being videoed. We will have the video up on our website. It's the WNGCPAS.com website under Community Association Resources. So after it's all processed and edited, it will be up on the website for you to share with fellow board members, fellow managers, or others that you'd like to share it with. We're going to, as we go through this, we'll have each speaker introduce themselves rather than me go through their intro. And we're going to try to end by 8:45 at the latest, so you'll have a little wiggle room in order to get to the debate. We will also address your questions at the end of all of the speakers, because it's conceivable that something that may pop into your head while one person's speaking, one of the other speakers may cover during their presentation. So the order is going to be first Arlene Stern is going to speak, then I will speak, and then Joel Ellis will speak. And to start this off, we're going to have Arlene, who's going to lead us in an initial dialogue to try to make sure we get at the issues that you want us to get at and focus on those issues. And I apologize for the confusion in the interest of being punctual and not penalizing all of you who are on time. For those who are a little late, we started on time, so just bear with a little bit of the commotion. So I'm going to turn it over to Arlene, and we'll take it from there. Arlene?
Hi. Just by way of show of hands for a minute, so we know who the audience. How many are board members? Okay. How many are management companies? And how many are other that I didn't cover? And others are former board members? Okay. Interested parties. What I'd like to do is just take a few minutes, and while each of us have topics we think we want to cover, we'll try and work in things that we may not have put in. So if you can just kind of raise your hand, tell us what you would like to walk out of here learning, what information would you like imparted. Hopefully we'll capture most of that for you. We'll go back at the end and answer some questions if we didn't cover it in each of the presentations. So what would you like to get out of tonight? Other than being out of here on time. Anybody? You want to leave it up to us? Yes.
I'm a new board member, so for me, I just want to get a good understanding as to exactly what you're covering here. I've seen it, I've seen your overview, so that's why I'm here.
Okay, and hopefully we'll help with that. Yes?
Better communication and transparency with the shareholders.
Okay. Yes, sir.
Yeah, I'd be most interested in the training and preparation of new board members and the use and training of committees.
Okay. Both of those I'm speaking to, so hopefully, yes, sir, and then back here.
Other than trying to learn to be a good board member for our building, it was just presented to me just recently about the liability board members have.
Okay. Okay. I know Joel's going to cover that.
Board members' interaction with their professionals.
Okay. Yes.
Functions of board as opposed to functions of management.
Okay. Okay. Anybody else? Okay. Hopefully, I think, yes, ma'am.
I'm also a new member of board dissemination of information to the rest of the units for homeowners.
So board to shareholder or resident communication. Okay. Got it. Hopefully we will cover most of that. So on that note, I'm going to kick it off, and then it's going to Ed, who's over there, and then to Joel, and then all of us will take questions at the end. I was asked to tell you a little bit about myself. I'll make it quick. Up until May, when I decided to retire, was the former board president of this building for 6 years. I'm now, because I'd like to stay involved and the board would like me to stay involved, I'm now chairing the finance committee. Professionally, I spent my entire career in retail. I have an undergrad degree in labor relations and an MBA. Grew up in the supermarket industry, working for Pathmark, doing labor relations and human resources. Moved from there into another side of retail, department store, where I started doing operations in addition to the areas that I had. Worked for a company called P.A. Bergner in the Midwest. You'll never know of it. Privately held Swiss company. When I joined the company, we were $200 million. When I left, we were $1.2 billion. Then went to a company called Casual Corner, which most of the women will know. I was the chief operating officer. We had 1,600 stores across the United States. And then ended my career as the CEO of a company called Gantos, also retail. So I've done the gamut on all fronts of retail, but progressively from the labor side to the human resource side to the operation to the merchandising to the finance and everything. So that's my background. Excuse me. Okay, let's see if I can do this right. The speakers you've already heard about. I just want to, I'll say this up front on terminology. I tend to use the word shareholders because I come from a co-op. For those that are condos or other community associations, doesn't mean I'm not speaking to everybody. I will try where I remember, but it's like one of these things you just get used to. I will try to say shareholders or residents. I'm also going to use the word corporation because I think one of the things that we all have to realize is even though we're buildings, we are corporations. And I think when we talk about some of the issues that you were talking about with liability, communications, and I know a lot of things that Joel and that Ed are going to get into, I think we need to keep that in the back of our head. Okay, I want to talk primarily, I'll call it the operating side of it, how a board functions. These were some of the questions that you asked. How we can prepare ourselves better to be more effective board members. How do we understand and meet the financial, operational, legal, and I'm going to throw in the word strategic responsibilities of a board member. It's critical to the success of the board, the entire board. And the only thing I'll ask is, even though we're individuals, that one of the things we need to always keep in mind is that we represent the shareholders. We represent the residents. So the board has to be a cohesive unit. The following on this screen are some of the topics that we'll be talking about: understanding board responsibilities, training and preparation for new board members, the use of and training of committees and committee members, best practices, management and operational audits, performance evaluation, oversight of management and employees. If you're satisfied with how your board is functioning, the next question is, how do I make it better? If you're not satisfied, the question is, what are you going to do to make it better? When I was the CEO of a public corporation, I would tell our outside counsel before I would sign any SEC documents that I need to read them. And yes, that pissed them off royally. But there's an obligation that comes with being a board member. Why you got on the board or why somebody else gets on the board, once you're there, doesn't matter anymore. You're there as the legal representative. You are there to represent the shareholders and officer of the corporation. And if something goes wrong, it's the board's responsibility. Yes, there's management. Yes, there's a manager in place. Yes, there are managing agents. Yes, there are outside resources. But ultimately, just like when I signed documents for the SEC, and I had a CFO, and I had outside counsel, and everybody prepared it, if they were wrong, they were coming after me. I was the one going to jail. It was my name on it. So I wanted to make sure that it was run correctly. Community properties are corporations, and the boards of community organizations have vested in them the same fiduciary responsibilities and roles and obligations of a corporation. So when you think about that, and you think about your responsibility, keep that in mind. Okay, so what are some of the responsibilities of a board member? And for those of you, a lot of this is going to be routine for you, but maybe, just hopefully, will give you some additional insight. In simple terms, what I would say is the role of a board is to increase the value to the shareholder. Number one, number two, number three. Increase the value to the shareholder. Financial oversight, operational oversight, and strategic and long-range planning. So what does it mean when we say increasing the value to the shareholder? And how do you go about doing that? Well, one way is by ensuring that the corporation is sound, that it's financially set, both short and long-term, which means you need to be looking 5, 10, 20 years out, that the budgets are realistic. Yes, there are times that things happen, like they raise taxes more than we expect in the town we're in, but what's your contingency? How are you going to overcome that if it happens? The easiest thing to do is say, we can do additional assessments. I will tell you it's not always the most prudent thing. I will also say to you as a former board president for 6 years, we have not raised maintenance in this building in 5 years, and we have not cut back any services. In fact, we've added. Second part of that is making sure, which I know Ed is going to talk about, that you have sufficient capital and operating reserves, and that they are there at a time when they are needed, sufficient to the needs of the building. The third is that we're consistently maintaining and upgrading the infrastructure of the building. It doesn't matter if you're meeting a budget or if you're meeting your capital budget if the next board has to deal with a crumbling infrastructure. It's a balancing routine that has to constantly be looked at, constantly evaluated. The increase in the value of the shareholders' units is a way of looking at what your board brings to the picture. And the other is services to the shareholders to meet their future needs. The second item, is building culture. Now, it's a word that's often used in terms of corporations. What's the corporate culture? Not everybody uses it in terms of community associations, but I think it has a place. And the reason I think it has a place is I know when we have new people move into this building, one of the things that we constantly hear is I hear about the culture of that may not be the word they use. I hear about the activities, I hear about the events, I hear about the things that you do for shareholders. So the question is, what do you want it to be? What is your building? What do you want it to look like? I'm not talking about the physical, I'm talking about the culture. How open, somebody asked a question about communications, how open are your communications? How thorough? How easy do you make it for shareholders to get their issues addressed? Do you monitor that? Do you measure it? Do you hold people accountable to how quickly they respond to shareholder needs? What kind of events do you run? What kind of parties? What kind of speakers? I mean, we do almost every Monday we have a speaker. We show movies 3 nights a week. That's why we have a theater. What kind of orientation do you do for your new residents? To introduce them to other people in the building, to introduce them to the services, to teach them about your health club if you have a health club, or to teach them about your social room. It doesn't take long, but it creates a sense of community. It creates a sense of I'm welcome when I move into this community, as opposed to I live here. This is my community. That's what I mean when I talk about culture. Policy development and implementation. I mean, basically speaking, every one of us has house rules. How user-friendly are they? There's a fine line because you also have to protect the corporation. You have to worry about insurance issues. You have to worry about liability issues. But how friendly are your rules for your shareholders or your residents? And your employee rules? Are your employee rules and what they're expected to do consistent with the culture that you say you want as a community? Strategic planning, also one that doesn't get mentioned a lot in terms of community associations, but I think is critical. Where do you want to be 10 or 15 years from now? No different than any other corporation. What type of building do you want to run? What are your financial needs for the long term? How do you avoid consistent assessments on your residents? How do you bank money today for future uses? How do you upgrade your infrastructure? How do you balance your day-to-day with your long-term capital needs? I like the analogy that if I've never been to Maine, I'm probably going to go on Google or one of the MapQuest, and I'm going to download a map. And I may head up to Maine, and I may find that I have a detour, or I may find that there's traffic or construction, and I may have to work around it, but eventually I'm going to get to Maine. To me, a strategic plan is no different. If you're driving your business, you're driving your building, you're driving your association, you need a roadmap. Yes, there will be crises. Yes, there will be obstacles. Yes, there will be shortfalls. Everything else that any business faces. The question is, how prepared are you to overcome that? What are your strategies for an emergency? What are your strategies for protecting and building and replacing your infrastructure? What are your strategies for building the culture? And how do you move your day-to-day, which is what 90% of the time we focus on, at the same time that you focus on moving along that continuum or that roadmap, so eventually you end up in Maine and not back where you started. There's a saying that I love: if you always do what you've always done, you'll get to where you've always gotten. That was by Henry Ford. And it really is very simple, because we all get caught up in the day-to-day. And we all focus on the problem in front of us. And many of us as board members also hold down other jobs. But a little planning up front goes a long way towards the end. And on a yearly basis, if you're monitoring that plan and you're reworking that plan and you're revisiting it and you're refocusing it and you just do a little piece at a time, you wake up a year from now, 2 years from now, 5 years from now, and it's amazing you've gotten most of it implemented. Performance evaluation. I'm talking about performance evaluation of ourselves as board members. Periodically, we need to assess the board's performance. What do you know? How are you working your plan? What are the goals? What constitutes good performance? How do your shareholders measure you? How do you measure yourself? And once you assess it, it's fair to share it with your shareholders. If you want to talk about open communication, tell your shareholders what you've accomplished and tell them what we still have to do. They should know what the plan is, whether it's a capital plan or any other part of it. They should know these are the 5 projects for the next year. These are the 10 projects for the next year. So they have expectations. We envision can't always commit that you won't, but we envision not having to raise an assessment. We envision having to put these services in place. From time to time, you may want to do studies or surveys of your shareholders. Make them partners in what would please them as a shareholder or resident. Financial oversight, I know Ed's going to do most of that, but I just want to touch on it a little bit. It's a balancing routine, long-term, short-term, long-term, short-term. It's looking at balancing your needs, your reserves, your cash flow, and making sure that what you have in place is there when it is needed. Okay. Understanding the role of the board. We've already spoken a little bit about board responsibilities. People run for boards for different reasons. I'm not here to assess good or bad why they run, but keep in mind that everybody runs for the board with a little different agenda, and we all have agendas. Understand your co-board members and why they're there. You don't have to agree or disagree, but if you understand what reason everybody has, it may give you some insight into how you work more cohesively as a board, How are you going to function as a group? What backgrounds do each of your boards bring to it? And when you're looking at future board members that are going to run, are you trying to get people who balance the board? And we had, we had a CPA on our board, we had an attorney on our board, we had a property management person on our board, we had business people on our board, and we each brought something different. But when you put us together collectively, we had a set of skills that was stronger collectively than we were individually. How do you educate new board members was one of the questions, or if you are a new board member. There are some things you can do as a board member. You're welcome to look at this later, but I brought it down. This is a book that I put together, and every new board member got a book. What was in it? The proprietary lease, if you're a co-op, the bylaws, the house rules, our admissions policy, again co-op, our alteration policy, alternative dispute policies, our charges or fees, our capital reserve study, our budgets, our committees, committee policies, our committee membership, our purchase policy, our investment policy because of the funds that we have, our lease abstracts, our contract abstracts, a whole bunch of other things. What does that do? If you have every new board member, the hardest thing to do, at least I found, the first time I went on the board here, was to educate myself. I knew retail. I didn't know anything about a community association. And by the time I dug up all these things, I was probably 6 or 8 months into my term and still trying to bring myself up to speed. So as a result of that experience, I said, okay, wouldn't it be nice if the next person that gets on the board doesn't have to do that, and we can begin the education process right off the bat. So now every board member gets a book. Obviously, I can't make anybody read it, but we can encourage them to read it. But the point being that if those documents are the right set of documents, 90% of the questions that they have as a new board member are there. And they can look it up, and they can read it. That's one of the ways you can educate. The other is to get help from your attorney, your accountant, from outside people, vendors, and do some mini seminars for your board members to educate them. You have an energy consultant, bring in the energy consultant, let them do a little seminar. It doesn't have to be long, it can be 15 minutes for the board member. Try and keep the politics out of the board. You can all laugh at me because you're going to say that's not possible. But if you ask the following question every time you make a decision, is it in the best interest of the shareholders? And you balance the needs of the shareholders with the needs of the corporation, at least you will go a long way to minimizing the politics, because that's the criteria. Create a book. Again, you're welcome to look at it. Create an electronic file. Have your attorney have a copy of all the key documents electronically. I gave ours a flash drive with every key document. Make sure there's a good, well-written ethics resolution in place for board members, and make sure you enforce it. It protects you, it protects your board, it protects your building, and it protects your shareholders. Make sure that you have the right legal and liability protections and insurances. And don't take it for granted. We go out to bid every year, and we have somebody periodically reviewing it because things change, and we may not always understand the changes. I don't know that 12 years ago we had terrorism protection. Today we have it. You need to understand what's happening, and you need to make sure that your building has the right kind of protections. Again, engage others in training, and can also be existing board members, your accountants, your attorneys, your vendors, your management company, professional organizations. I'll put a plug in FLICA. We're starting like a series of education seminars for the delegates of FLICA because they too asked for that. Okay, let's talk about committees. I'll be the first one to tell you, committees can be your best friend and they can be your worst enemy. But they're very valuable if they're utilized correctly. They can supplement the knowledge that board members don't have, or the management companies don't have, or that your manager doesn't have. but it should not, quote, not interfere with the manager's ability to manage the building, and it is not meant to replace the management company or the outside professionals for a lot of different reasons, not the least of which is liability. There are certain committees that may be mandated by your bylaws. There are others that may be mandated by law, but here are the ones you should think about. Admissions, if you're co-op, ADR, Alternative Dispute Resolution, which I think Joel will talk about, finance, engineering, house and grounds, social. And they all have different purposes. If you talk about your culture, a social committee that plans events or plans speakers is invaluable. If you're going to do a lot of capital replacement, an engineering or construction committee, if you've got the people in it, need to be very clear what the roles and the responsibilities are of a committee. Need to make sure that the committees understand it, then you have a selection process. Never forget, committees work at the behest of the board. They are not a replacement for the board. The ultimate responsibility and liability is with you as a board member. How they function, what qualifications they bring, and how they interact with the board is strictly up to the board. You need to think about how they call meetings. Is the board setting the agenda? Is the committee setting the agenda? Or is it a combination? Is it top-driven, board down? Is a committee bottom-up? If you don't strike the right balance, you're going to have a committee that is very unhappy, or you're going to have a board that's very unhappy. So it has to be a balance of top and bottom-up. Issues to consider in setting up committees: insurance, liability, and I mean, Joel may correct me on this, but we had our committees covered under our D&O insurance, legal issues, ethics, policies, operationally, how do they interact, who do they interact with. You want to make sure that if you have no conflict of interest for boards, you also have it for committees. They should sign the same kind of statements as a board member does. Best practices. Why is it important? Because it provides a benchmark for you to know your building's performance and your board's performance. It provides a vehicle for you to learn from others who may be doing something better that can help you improve your building. Never, never, never invoke the statement "not invented here." I have some overriding principles, which are: what can I do to improve the experience of my residents? And how can I do more for less? Doing more does not always mean spending more. And again, I'm going to say, in 5 years we've not raised maintenance, but we've increased services. How did we do it? By finding other ways, by shifting an energy, by creating and shifting an energy strategy, by saving $500,000 in energy. How will I do today lay out in the future? One of the key principles from a best practice standpoint you need to keep in mind. The best practices that you can review: expenses, energy, building services, equipment maintenance. These are all pretty self-explanatory. By equipment maintenance, I'm also going to say keep great records. We just went through a refinancing in this building, and one of the things we were able to do was turn over a list of every project done in this building for the last 10 years. I mean, our mortgage company was ecstatic because it gave them a very easy view, and when they appraised the building, they understand what we had done to maintain and improve the infrastructure. Understand the useful life of your assets, security, staff pay, emergency preparedness, different policies, your house rules, and your union contracts if you're a union shop. I'm going to say the union contract to me is not about what we pay. The union contract is about the flexibility that we have to operate the building in a manner that's consistent with the needs of the shareholders. Okay, management and operational audit. We want to talk about why is it important. One, it gives you history. It gives you performance targets. It ties to your financial needs and connects them to your operation. and it's great for transition. Unless you're planning on being on the board for life, you have to worry about who's taking it over, who's the next heir apparent. You want to talk about services provided, what do people want, and why do they buy in your building, or why do they come to your building? Maintenance schedules, operational and equipment. These are management issues, but they're management issues that the board has to have an oversight into. Contracts, do we have the best terms? What's included? Where do we get hit with extra charges? How do fees get paid? How many years have we locked into? That's looking at it from a little different perspective. Capital reserve study for your long-range planning, records and record retention for the history, for legal reasons, for insurance reasons, and I just mentioned the mortgage issues. Maintaining inventories and how that's shown on your books. Evaluating insurance coverage periodically in the bidding process. Your building plans, are they all in one place? About 5 years ago, we converted all of our plans to electronic plans. Now we have a disk that has every plan in this building, and every time we do a capital project, we update the electronic files. Operational manuals, the how-tos, the guidelines, if you change staff, if you change managers, if you change managing companies, if you change board members, it's memorialized, and of course your administrative side. Performance evaluation speaks for itself. We all know what it means, besides evaluating ourselves as board members. It's looking at your management company, your management agent, your internal staff, your legal counsel, your auditors, your investment advisors if you have them, your engineers, your vendors, and consultants. Relationships are great, and I am a strong proponent of long-term relationships, but I gave somebody this evening an example. We had the same bank for 20 years. We did a refinancing. We said to them, we're going to go out and bid it, never thinking that they wouldn't be the lowest. They weren't the lowest. We went back to them and said, you got to be kidding. And within 24 hours, after they went into catatonic shock, they came back with a lower bid. Relationships are great. And again, I'm going to say I'm a fan of maintaining them, but you always need to know what else is going on out there, and you need to keep everybody honest. Oversight of employees and management. Need to look at your hiring practices, your pay practices, your benefit issues. And I don't care whether you're union or non-union, this is all applicable. Your employee rules, how you promote, disciplinary practices, employment, legal, compliance, which Joel is going to cover separately. In closing, and I'll answer questions at the end, I'd like to leave you with a couple of thoughts. I'll leave you with a little poetry. Robert Louis Stevenson said, quote, life is not a matter of holding good cards, but of playing a poor hand well. We can't always choose the obstacles that we encounter. We don't always know what we're coming into as a board, and we don't always know the future. But if you understand all the cards in the deck, and you know how to shuffle them, and you know how to play them right, you can take a lemon and make lemonade. You can't control whether the borough of Fort Lee raises taxes. That's almost a given they're going to do it. But if you're prepared for ways to offset the increase, it can make the difference between how often you have to go back to your residents or your shareholders and ask them for money, or you can cover it because you have a plan in mind into how to overcome it. Second one I'd like to leave you with is never let anything urgent get in the way of something important. There'll always be something urgent that comes up, and it will always stop you from doing the important thing, which is to plan the future of your community. Don't let it go there. Yes, you have to pay attention to the day-to-day. But again, I'm going to talk about that roadmap. If you're trying to get to Maine, you got to move along the highway. You need a vision as to where you want the building to go. And a vision is a search for meaning, or what you want, who you are, where you're going. But a strategy is a search for advantage. And unless you have a strategy in place, you're not going to optimize your vision. Without a strategy, you can't gain a competitive advantage. And by competitive, I mean being a building where the values stay high, being a building where people choose to live. You have to understand what happens when there are increases in expenses, which there will always be, how to improve and maintain shareholder values, how to reduce turnover, and how to leave your building as a board member in a strong financial position. Mr. Jacob.
Thank you, Arlene. That was an excellent presentation. I think the takeaway is, at least for me and others, is that you're not just running a building, paying expenses. Arlene has the right idea. It's about strategy and where you want to take your building and how you want to make it a better building and a more effective board to help the building get there. So thanks for that insight.
And that takes up 5 minutes.
Okay. Before I begin, I'm going to pass around a sign-up sheet. We have a quarterly newsletter that we send out every quarter to our community association clients, buildings, and so on. We also have a survey coming out. We do a survey every 3 years, I believe it is, 3 or 4 years. Jules is the lead on that. That surveys all of our community clients and gives you comparative statistics of how your building stacks up, or you'll see how your building may stack up with others, from how you fund reserves to what your monthly assessments are, etc. So if you sign up, you'll get that email, you'll get our regular newsletters, and you'll get the survey, you'll get our newsletters, and if we have special webinars or programs, we will send you that via email. We promise not to overload your inbox, but it'll be interesting stuff, and you always have the ability to opt out if you get tired of us. So I'm going to move into some of the more on-the-ground issues that you face as a board member, the things that day-to-day come up. We're going to talk about operational issues. We're going to talk about replacement funding issues, the annual audit, tax returns, the role of the Finance Committee, and a little bit about investments. The broad view of this is that board members are fiduciaries and are fiduciarily responsible for what goes on in the community, and that's the basis from which you have to make these decisions. So let's first go to some concepts about operational issues. The first is delegation versus abdication. And, you know, it's fine to delegate responsibility to the managing agent or the on-site manager or whoever your professionals are. They know how to do it best. You just have to understand you can't abdicate responsibility for what you've delegated. So while you might delegate project approval or some level of check signing, whatever it might be, you can't walk away from your responsibilities to make sure that that process is appropriate. So again, it's okay to delegate. That doesn't mean you can abdicate your responsibility over those items you've delegated. One of the key functions of the board is the responsibility for the annual budget process. And as Arlene talked about strategy, this is the roadmap. This is where you turn left and you turn right to execute on the strategy that Arlene has talked about. It requires leadership. It requires sticking your head above the crowd and making decisions that, for some people, it's not immediately popular, but in the long run, it's what you need to do. And some of you may or may not be aware of this, but the major issue here in managing your budget and long-term affairs of your building is that you need to keep the assessments at a level amount over a long period of time. What you don't want is ups and downs in maintenance assessments to cover expenses that you haven't properly planned for. And the reason is that's the primary way you run into delinquency issues. People plan their personal budgets based upon the monthly assessments. They may not necessarily be able to handle unexpected assessments because of a lack of long-term financial planning by the board. We see it a lot. The board doesn't want to raise the maintenance fee. They look great to the unit owners, and then the next board that comes in is now faced with a huge amount of problems for which they don't have the money and can't, are now the bad guys because they're making the assessment. The right answer is look long-term, be a leader, set the budget with the long view in mind. Another thing, and again, you may or may not experience this, but you need to look at the kind of financial reports that you're getting as a board member and see whether they're appropriate for managing your community. There's the internal financial statements prepared by the management company or on-site personnel. It could be cash or accrual. The message for you is accrual basis financial statements are the standard. It's the best way to manage the financial status of your building. Cash basis financials, which are based upon cash in and cash out, can mislead you down a nasty path. So accrual basis financial statements is what you want, and you want to see it in relation to the budget. And the best practice is accrual basis monthly financials compared to budget, current month and year to date, so you can see where you're headed. The next issue is internal controls and the cost of controls. And this is an interesting issue for board members because I think one of your responsibilities is to make sure that the internal control system in your community is appropriate, which means are there the right checks and balances? Who signs checks? Are the checks signed based upon approved invoices from the property manager or whoever is approving the invoice? The balancing act here is you can take the controls to the nth degree and then it becomes an ineffective control because it's way more costly than what it's trying to prevent. So to use a very extreme example, you can require every check to have all 5 board members sign the checks to make sure nobody is committing fraud or it's not inappropriate. Clearly that's ineffective and is too much. So there's no right answer to this. I just want you to be sensitive to, there's no right answer to internal controls. It's a balance between the control you're achieving and the cost to implement the controls that you're looking for. And don't be impractical. Understand that you don't need to spend money on all kinds of controls for a remote risk that there could be a problem. Take the risk that there could be a small problem and don't spend lots of money and energy and focus on controls that are too much. Spending approvals, limits, signatory authority kind of falls into the same category. You need to balance being practical with being prudent and know where the risks are and where you're willing to take a little bit of risk over the process. And you know, another example is in your community, if you have 2 check signers, they sign the checks, and then every month the board gets a list of all of the checks written by that, all the checks that were written and dispersed. Well, you have a control there because you have the secondary control of seeing the list of all the disbursements. How many people do you need to sign the check, and what kind of signatory authorities do you need to impose if ultimately the board's going to see what goes out? So those are all things to consider in the process. Another interesting area is other income categories, and this is mentioned because it's often overlooked, and you as board members need, again, those of you who are board members, need to understand what the issues are and then tackle them head on. So, you know, we have some buildings have garages. You need to understand how the garage operates. There's in-unit services where the maintenance people in the building are providing in-unit services to the individual residents. There's a couple of issues there. One is that there is sales tax that should be charged on in-unit services. And secondly, you want to make sure that you have controls in place over your maintenance staff so that they're not performing in-unit services and it's not being remitted back through the association, that they can't be doing that while they're out and about in the building. There's also, I'm going to go to holiday funds. A lot of buildings we see, they take up collections from the residents, and then they take the money at Christmas time and they give it to the employees. And sometimes it's a committee of people, sometimes it's a couple of board members. There's all kinds of ways that this manifests itself. Well, the problem is that once the board is in any way involved or knowledgeable about this practice of collecting money from the residents and giving it as tips and holiday gifts to the employees, that is taxable income to the employees. Those are wages. They're not gifts. You can't make a gift to an employee. A gift to an employee is additional compensation. There's no such thing as a gift to an employee that works for you. So if you have the holiday fund, it's really additional compensation to the employee and needs to go through the whole employee payroll system. The second thing, which maybe is less important but also a concern in my eyes, is the board should be determining, or management determining, how employees get compensated. It should not be that the residents now have free rein to compensate employees out doing work about the community, because you can imagine the abuses because somebody's giving a particular person money for particular favors. It just doesn't work from a management perspective. Compensation, as Arlene pointed out, employee performance appraisals, all of that stuff needs to be centralized by management through the board and should not be left to the decisions of individual unit owners as to who of your workforce gets compensated. Sales tax, there's quite a bit to talk about on sales tax. I'm not going to go into it, but particularly with co-ops, the state of New Jersey is looking for revenue under every rock and is often looking at co-ops and large condominium projects for sales tax. You're wondering, what does sales tax have to do with a condominium association or a co-op? It has to do with when you go out and buy items that may be from an out-of-state vendor that doesn't charge you sales tax, or a repair man or a company that doesn't charge you sales tax. The state looks for that stuff. They will come in, they'll look at all your purchases, they'll see whether you paid sales tax to an out-of-state vendor, and if you didn't, there's something called use tax, which means you need to pay use tax on something you've bought out-of-state from an out-of-state vendor. That whole system was designed so that out-of-state vendors don't have a competitive advantage to in-state vendors because of this New Jersey sales tax. So if you're buying things out of state, you need to be aware of the use tax filing, and somebody needs to be filing quarterly sales and use tax returns. We usually recommend that you file them. If you don't have any of that, just file it with a 0 anyway, because it starts the statute of limitations on the assessment for sales tax. If you don't file, it's unlimited forever. If you do file with zeros, they can only get you for 4 years at a time. So the idea is to do it with a 0. Payroll practices and controls. I kind of alluded to one issue, which is the in-unit services. There are lots of issues when you have a lot of employees on staff. Who is authorizing their time cards? Are their hours accurate? Are there things going on with your labor force? Do you know everybody who's on the labor force and on your payroll? There's lots of room for abuse unless there is careful scrutiny. You need to have good supervision, a segregation of duties, which means there's one person who approves the payroll and another person who disperses the payroll checks, etc. But just to understand, where there is payroll, there is the opportunity for things to go on, and you should be comfortable that you have a payroll system that will catch that. Arlene talked about record retention. Record retention should be part of the system of controls in your building, and the best way to do it is have a chart of every type of document you have and how long you should keep it, and know where it is and know that it's safeguarded. Lastly is FHA approval. This is sort of a sleeper issue, but you should understand what's involved. If your building is, if you are FHA approved for mortgages, you need to know what the requirements are. It's a very involved discussion. I'm just alerting you to it. If you have not addressed it, you should be aware of what the implications are. Okay, we're going to go on to the replacement fund issues, which relate to the long-term capital replacement funds that are set aside. This is, again, one of those sleeper issues because you don't know you have a problem until you have a problem. If you put your head in the sand and don't fund your reserves adequately as you go, you may not know tomorrow, you may not know in 5 years, but somewhere you're going to hit the wall and not have enough money to do what you have to do. So there's a concept of doing a replacement study. How many of you are familiar with what a replacement study is by an engineer? Okay, that's good. The engineer will make an assessment of your building, look at the age of items, and kind of chart out when they have to be replaced and make sure that you have a schedule of saving up money so you can make those replacements. Those studies need to be updated regularly because items age, things happen. So the general recommendation is every 3 to 5 years you should have your replacement study updated by the engineer. There's also different ways of funding reserves, and without getting too technically involved in this, there are 3 basic ways to fund your reserves, yielding different levels of funding, and they all have different levels of funding and different levels of risk that you won't have enough money set aside at the time a replacement needs to be made. Full funding is just one of those cases where if you have a roof that is $100,000 and it lasts for 10 years, then you put $10,000 a year away, and at the end of 10 years you have $100,000. That's the richest way to do it. There are other ways that the engineers have come up with to fund reserves. The most popular is this threshold funding level, which is a calculated way to fund so that over the life of your building, you have the money in reserves, you just don't have as big a cushion as you would if you did full funding. Again, I don't want to get into all the mechanics of it. There are different ways to do it and different thresholds. The point for all of you is you need to know what those options are, and you need to know what fits for your building and what doesn't. There are ways to use those strategies of funding to make your budget work and make sure that you ultimately have enough money set aside. We often see signatory rights over the replacement accounts being different than the operating account. I don't know that there's any right or wrong reason or way to do it, just pointing that out. The other thing I want to mention is just one more point down, which is evaluate needs for other long-term capital projects. You have a replacement fund that has supposedly captured all of the items that you need to replace at a certain point in time. There are other things that you may decide need to be done in your building to enhance the value, correct a problem, or add something to be competitive with other buildings in your community or in your area. So that's a whole nother long-term capital planning exercise you need to go to in addition to the replacement fund. The replacement fund isn't the end-all and be-all to all your capital needs. And we're seeing more and more as buildings and communities are trying to stay competitive, they're embarking on more robust programs of capital improvement to keep their buildings competitive. Bidding procedures, obviously you should have a good one. And using member accountants and engineers to do your replacement fund, it's always problematic because it's very difficult to tell a board member, engineer, or an association member that their idea is off base and they don't understand the industry. They can be the greatest engineer, but they may not understand the industry and how it works. And my recommendation is no matter how good a deal it is, don't use a board member and don't use a member of your community to do your replacement fund study. It's a problem waiting to happen. Annual audit and tax return. This is what you should be getting, or you should see as part of your annual audit. There's an engagement letter which specifies the term of your engagement with the accountant, the fee, who's servicing the account, and who's responsible for what information. That needs to be signed off before you start the engagement. At the end of the audit, when the auditor hands you a financial statement, they ask you to sign a representation letter, which is a letter that acknowledges the financial statements are your responsibility, not the accountant's. All the numbers in that financial statement are the board's numbers. It's not the accountant. All the accountant is doing is issuing an opinion as to whether those financial statements are fairly presented. So the representation letter is the board's acknowledgement that it's their financial statements. There's a couple of things that you get in the course of the audit. There's an SAS 114 letter and there's an SAS 115 letter. The 114 and 115 letters are required by the accountant to communicate in writing to those charged with governance any weaknesses, deficiencies, matters that came to their attention. You should make sure that you get those letters. You should always have an SAS 114 letter. The SAS 115 letter is when you have a significant deficiency that needs to be reported to those charged with governance. That's more problematic, less likely, but you need to ask whether you're going to get one of those or not. We spoke about the auditor's opinion letter, and every audit should get a letter back from legal counsel as to whether there's any outstanding litigation in process or claims asserted or unasserted against the community. Tax returns, that's probably not the most exciting topic for tonight, so all I'll tell you is that you need to make sure your tax returns are filed on time. March 15th is the due date for a calendar year end, 2.5 months after the start of the year. You must file an extension, and then if you have that extension, you have another 6 months to file the return. They must be filed, and you as a board member need to make sure that that's happening. And there's both federal and New Jersey filing requirements for co-ops. For condominiums, there's only a federal return required. Lastly, distribution of reports and access to records. I'm all for access to records in accordance with documents. I'm not a proponent of sending out financial statements, and this is a generalization, unless called for by the documents or part of your culture, to be sending out lots of financial statements that people don't understand. It's available for everybody upon inspection, not necessarily something to be sent out again unless your document's required or you have a history of always providing it to all your residents or shareholders. But check on that first, because you're often sending the financials to people who may be uninformed, and it could be problematic. Auditor selection, the last thing I want to talk about is, it's next to last. When you select the auditor, you should be looking for a confirmation that it's going to be timely, accurate, and that the accountant has industry knowledge. They need to be independent. They need to have a peer review done, which is an investigation or an examination by another accounting firm of the system of quality controls within the auditor's firm. And there's a letter issued, a peer review letter. Your accountant should provide you a peer review letter if you ask for it. Lastly is auditor rotation. You might think auditor rotation is a good idea. I will tell you that the idea of auditor rotation in the abstract may sound good, but it's problematic for a couple of reasons. Number one, the real criteria of the auditor you should have is somebody who understands the industry, understands the community, understands the audit process, and is responsive and knowledgeable about your building. Just changing auditors because you think a fresh set of eyes is going to find something. Actually, the New Jersey Society of CPAs has a position paper on this. Sometimes, and the conclusion is that changing auditors for a fresh set of eyes doesn't mean that the new auditor is going to catch anything. In fact, the new auditor takes time figuring out what's going on in your building and may be less likely to find a problem than somebody who's familiar with your building and the nuances, and they spot an aberration more quickly than a brand new person in the building. Again, the key to this is that you have a knowledgeable accountant in the industry. That's what you want, and don't just focus on the fresh set of eyes idea, which doesn't work. And I'm telling you that whether I'm trying to get a new account or not getting a new account, the real answer is if you're going to hire somebody, find somebody who's knowledgeable. That's who you should be looking for. And maybe it's me and maybe it's not. And let's see, I think I'm just about out of time here. This is the last slide. It's going to really corroborate something that Arlene said, which is, and I'm going to talk about the Finance Committee. The Finance Committee's role is advisory. The Finance Committee doesn't approve anything, doesn't have approval rights over the budget, over check signing, over anything. The Finance Committee is advisory, but they could be a very valuable advisory function. They could interface with the accountant and so on. You just have to understand it's done at the pleasure of the board to serve the board. And we often deal with finance committees rather than the board because the finance committee understands the numbers and the way we do things, but and then they relay it to the board, but we don't answer to the finance committee, we answer to the board. And reporting and transparency are key, and that's what should be the objective. And I think that's it. Now it's Joel is up. Thank you.
Good evening. My name is Joel Ellis. I'm a partner at Cates, Nussman, Rupone, Ellis, and Farhi in Hackensack. And I've been going to community association meetings for about 85 years, I think. What I'd like to address first is this issue of what is the fiduciary duty of a board member. In approaching that, there are two issues that have to be examined. First issue is if the board is intending to take an action, does it have the authority to act? And that involves an analysis of your governing documents. In the case of a co-op, it consists of the bylaws, the proprietary lease, and the certificate of incorporation. In the case of a condominium, it's the master deed, and the bylaws and the certificate of incorporation. The House rules or the rules and regulations are not a governing document. And that's very significant because, for example, we were involved in a case a number of years ago in which we, at the time, challenged the imposition of what is known as flip fees or transfer fees. For those who are in co-ops, they know what that means, against about 7 high-rise buildings in Fort Lake, claiming, among other things, that the boards which imposed this flip fee, which makes sense as a way of raising revenue for the board, for the corporation, did it by resolution of the board. It was not done by way of an amendment to any of the governing documents. And after about 6 years of litigation, we were successful in the appellate division, and ultimately the shareholders, over a period of about 6 years, received substantial refunds of the payments made because it was determined that the board did not have the authority to impose flip fees in the manner that it did. It also involves an analysis of the governing documents in terms of determining if a board has the right to accelerate maintenance, to impose late fees, to collect attorney's fees in connection with collections, to impose fines. All of the right to do that can only be set forth in a governing document and not in a rule and regulation. The next issue, if there's a determination that there's authority to act, the next question is the action a reasonable exercise of the board's business judgment? And there it assumes that there is authority, and in that case the boards generally have substantial discretion and to act, and a court would not substitute its judgment from that of the board unless it was determined that the board was involved in self-dealing or was acting in a fraudulent or unconscionable manner, or that in some cases it acted unreasonably and in bad faith. So again, you don't get to the second issue of the board's exercise of business judgment unless you can establish that there's authority. First thing the board has to do when it's intending to take an action is to ensure that it's complying with the Open Public Meetings Act in New Jersey. And that requires that any official action taken by a board must be done so at a public meeting, must be advertised in advance, and to the extent known, the agenda must be posted in a conspicuous place at least 48 hours in advance of that meeting. If that is not done, there's a basis for setting aside the action that's subsequently taken. Next, sometimes there's a fine line between determining whether or not the action is one of authority or one of business judgment. And interestingly, there was an appellate division case in New Jersey in 2007 that was not a published case, which means it doesn't necessarily have to be followed, but there was significant language in that opinion that should give some food for thought for board members. In that particular case, there was a challenge by a unit owner who claimed that the board did not fulfill its obligation under the bylaws and under the Condominium Act to preserve and protect the common elements. The claim in that case was that the common elements were deteriorating. The board in that case did not put aside the amount of money that the engineer recommended for reserves that was discussed earlier by Ed. In that case, there was a recommendation that approximately $27,000 a year be put aside, and only a fraction of that was done. There was a recommendation that the maintenance be increased to deal with these problems, and that was not done. So the case went to court, and the trial court ruled in favor of the association and granted summary judgment and held that that was a matter for the board to decide within its discretion under the business judgment. There was an appeal. The appellate division reversed. It's the only case that we have found in New Jersey that precisely deals with this issue as far as the duty of the board in this regard. And the court said there needs to be a trial to determine whether or not there was a breach of fiduciary duty in that the board failed to follow the statute and preserve and protect the common elements and create adequate reserves for the building. Now, what does this mean in practice? What it means is that a board cannot or should not just ignore what its professionals are telling them needs to be done in terms of capital improvements. I don't think it means that the board is exposed if it doesn't follow in all respects what is being recommended, but there has to be a plan and perhaps interaction with someone like Ed to review how best to deal with these issues in a long-term way. Failure to do so puts the board at peril to a claim that it breaches its fiduciary duty. There was another case actually involving a building in nearby called the Buckingham, where a famous case not too long ago where an individual wanted to do an alteration in his unit, and the board turned him down. It was determined that the action of the board in doing so was arbitrary. And in fact, in that case, the board rushed to start litigation against the unit owner. And the court ultimately determined that there was a breach of fiduciary duty, that the court acted unreasonably in exercising its making a judgment about not permitting the alteration. And in fact, coming out of that case was a recognition, and this is important for the board as well, that the board should not rush to litigate, that the courts are saying very carefully that efforts should be made first to try to resolve the matter. And in that regard, as was mentioned earlier about alternate dispute resolution, it's now mandated by our law for community associations if a dispute involves a housing-related matter. And that alternate dispute procedure can be set up in a number of ways. Many communities, most of those that I represent, decide to afford mediation, to give the parties an opportunity to resolve the matter. And if they can't, then there's an opportunity to litigate. But this is now embedded in our law, and it's a mechanism designed to try to find an alternative to litigation. You also have to take into account state and federal law. Many of you, I'm sure, are familiar with issues involving disability claims that arise under the Americans with Disability Act or the New Jersey law against discrimination. And we've been involved in a number of issues in that regard. One issue, for example, involves parking, where many communities have a shortage of parking. There's a waiting list for indoor spaces. And a particular shareholder says, I'm disabled and I need an indoor space. The process has gone through. There's no doubt, based on information provided, that the person qualifies as being disabled. What does the board do in a case where these particular, there's a shortage of spaces, so there are none available? How do you get a disabled person a space? I don't know. No. There was a case, a federal district court case out of New York that raised that issue and said this is a issue of first impression as to whether the association can displace someone who already has a space for a disabled person. And then the court said, however, we don't need to decide the issue because there was some commercial space that they were able to turn in and make it available. So they left open that particular issue. That particular issue is still open in New Jersey. It would be my opinion that it is more likely that a court would say that the federal law and state law with respect to discrimination trumps an association's parking policy. And in that regard, you have to make it available. And it may be then an issue of determining what are the fair standards in how you go about finding a space. Does a particular shareholder have 2 indoor spaces? Is that shareholder living in the complex, using the space? There are a number of factors that have to be taken into account, but I think to just ignore and take the position that you have a policy and this person can be put on the waiting list or even number 1 on the waiting list, I don't think resolves the problem. Dogs, another issue. Many communities have rules that prohibit pets, prohibit dogs. Again, the issue of disability comes into play under circumstances where an animal may be determined to provide sufficient mental help for the particular shareholder or unit owner. And again, it's not a matter of just stating it, it's a matter of proving it. And that again, the cases are quite clear that notwithstanding that a board may have a policy of prohibiting dogs, if a person qualifies under federal and state law by way of disability, to have an animal, you have to accommodate them. Now, that doesn't mean they can run rampant. The board in that case can set reasonable rules regarding where the dog is walked. Perhaps the dog doesn't have to go through the lobby. A whole host of factors, licensing the dog, etc. What are the consequences if the board is determined to have breached its fiduciary obligation? There are some cases that suggest that the board could be liable for damages. There's one case out of Texas that stands for the proposition that a board could even be held liable for punitive damages if their action was so wanton or irresponsible. And again, as most of you who serve on the board know, that insurance does not cover intentional acts or acts that may rise to the level of being considered as being punitive in nature. So what can a board member do? I see everyone wants to resign tomorrow, I think. What can a board member do to try to protect itself against these claims? And I think one key thing it can do is to follow a particular statute which says that if a board member relies in good faith on the advice of counsel, that board member is insulated from personal liability. So in many cases, if there's a serious issue involved, it is important and desirable for the board to call upon its legal counsel to give it an opinion. Similarly, if it involves a financial matter, the statute suggests that the board can rely on people like at Guttenplan as they would through an attorney to insulate them from personal liability. In addition, you have to look at your bylaws. There are, the corporation is permitted to have board members indemnified in their bylaws for acts that they take, so long as they're acts taken in good faith. That's very important to look at. I'll just switch for a moment to the subject of collections. And just in terms of the distinctions between condos and co-ops, as you may know, in a condo, the bank that provides a mortgage has priority over your maintenance, over the maintenance that has to be paid to the association, except that if proper notice is given, the board would have, or the corporation would have what is known as a super lien. It would come ahead of the bank for 6 months of maintenance. In the case of a co-op, the co-op's first ahead of the bank. You don't have that issue. What both condominium associations and co-ops have to follow, it's very important, is what is known as the Federal Debt Collection Act. And that means that the way you go about collecting, given proper notice under the governing documents, and acting has to be followed precisely, or else there could be exposure by way of damages against an attorney for sending out the wrong type of notice, or against the corporation if it is involved in this process and doesn't do it properly. Bankruptcy, personal bankruptcy, you may know that if someone was bankrupt and any post-petition assessments following the bankruptcy, as long as the individual still resides there, would still be subject to collection. Pools, gyms, playgrounds, tennis courts. What we have tried to do for many associations that we represent is to have separate agreements reached between the unit owner or the shareholder and the association or the corporation regarding parking, for example, or the use of a pool. And incorporated in that agreement is a provision which would state that if the particular unit owner is in violation of the governing documents, House rules, or is in arrears, the board has the authority to take away that amenity. Now, it's a much stronger position for a co-op than a condominium, because there's been some case law that if the involving condominiums, that if your right to do so is not spelled out in a condominium statute, you may not have the right. That occurred at one time where the association had a right under its governing documents to charge late fees, but it wasn't authorized in the statute. The court said you couldn't do it. Subsequently, the statute was amended to allow it. But my point is, in this particular case, the board may opt to act aggressively here. There's always some element of risk involved, less so in the case of a co-op, but even if you, in the case of a co-op, for example, if it's not in a governing document, but you have it in a, you might be able to bootstrap that authority in an agreement. Releases, fitness centers. If an association permits an underage person to use the fitness center, someone under 18, and you want everyone who uses it to sign a release, that release would not be enforceable against someone who's not 18 years of age. And the case law seems to suggest that a parent could not lock in and release any claim that a child might have, a minor might have. That doesn't mean that for adults you can require releases. The releases, in my view, would protect you against any claim of negligence, but not protect you against any claim of something beyond that, gross negligence or wanton action of any consequence. Issues particular to co-ops. Again, you may know that in New Jersey, unlike New York, and prospective shareholder can only be rejected for economic reasons. So what happened years ago in New York when Barbara Streisand or Richard Nixon tried to get into a co-op, and the co-op decided they didn't want them there, they had a basis to reject for security reasons or otherwise. Not so in New Jersey. Your proprietary lease mandates that you consider it for economic reasons only. In that regard, I believe it makes sense for the board to consider adopting a resolution which would spell out what the terms are, what the standards are, setting forth what type of documentation needs to be provided, tax returns, bank statements, references, what type of ratios are required to determine if a particular individual qualifies between income and expense, loan-to-value ratios on the value of the apartment, and perhaps building in some discretion that if the board, give the board some flexibility that if it sees that there may be another way of a person, for example, posting a cash escrow, whereas someone may not exactly qualify under the standard, there may be some allowance. So that's something to look at. Your proprietary leases say that you don't have to give reasons on why you reject, and of course you can't reject for any discriminatory reason. And while it says that, in the event of litigation, it's going to open up anyway. And that's why I think if you have a resolution in place where, or a standard in place where you can specifically refer to that to show that there was justification for why the board acted, you will be in a much better position. Next question for a co-op, the issue of avoiding two classes of stock. Every one of your documents says there's only one class of stock in a co-op. There's an IRS regulation, section 216, that's very important. And what that says, again, that you must not discriminate between shareholders of the same class. There has to be only one class of stock. Now, we've been involved, and others have been involved in cases challenging that. Now, in some cases, it arose when someone was known as a holder of unsold shares, which initially was the sponsor or designees of a sponsor who were given the authority to buy apartments and not live in them and be freed from the obligations of complying with sublet policies. They don't have to go to the board for approval, only the managing agent. In some cases, they had veto rights over any bylaw amendments that may be adopted. And courts have stepped in and said, in this series of unreported cases that say, in that particular case, your rights as a holder of unsold shares should not continue indefinitely, should only last for a reasonable period of time. We had a case involving a situation where, without going into all the details, there was a different method of assessment for some shareholders as compared with others, because it started out many years ago as a rental. When it converted, the base maintenance was based on the last rental that was paid by each shareholder. So this perpetuated a situation of inequality, where some people were paying more and some people were paying less, not in proportion to their shares. This was going on for about 40 years. We came in and we went to court, and the court issued a declaratory judgment setting aside. And so there have been other cases dealing with a claim that a sponsor had a right of veto power. Again, that was set aside. What is very significant about this, and there was one case in a condominium context called Thanasoulis, and in that particular case, the board established a policy of charging fees for unit owners that were different from those who were not occupying. The court said that, in terms of parking fees, the court set that aside and said it's discriminatory. Now, what's the consequence here? The consequence, although surely not likely, is that if the IRS were to determine that there was a pattern of inequality or discrimination among shareholders of the same class, they could theoretically invalidate the co-op, which would cause everyone to lose all their deductions for mortgage interest and taxes, etc. And in every one of those court cases that I mentioned, the court made reference to that as a concern. So it's not something that can be dealt with lightly and has to be carefully looked at. Subletting. New Jersey, in its infinite wisdom, passed a law some years ago saying that a board or a co-op does not have a right to set unreasonable regulations with respect to subletting unless it, from the inception of the co-op, had a no sublet policy in its bylaws and enforced it throughout. So, no unreasonable restrictions. There have been no case law defining what that might mean in a particular case. What the court does say, what the statute does say, is that does not mean that you can't take into account that for purposes of financing, for purposes of running a building, that you can require that a percentage of the building be owner-occupied, that there be a ratio that usually relates to what Fannie Mae or some of the lenders consider as fair. So that is a factor that can be taken into account. The board can also take into account, as I said, that, which is essentially the same thing, there should be a cap and no more than X amount of sublets. Done? Okay. Last item, tax appeals. Every year we have an analysis done by looking at the sale of the various sales in a particular co-op in a given year, multiply that by the total number of shares, add in the underlying mortgage, maybe take into account what cash is, and analyze whether there's a basis for appeal. Had a couple of other things, but we're running late, I guess, so I think I will stop here. Thank you.
we're going to do next is Arlene's just going to take a minute and revisit some of the issues that you all said you wanted to make sure we covered as part of the program. So Arlene will take care of that, and then we'll go, if we still have questions, we'll take questions from any of you who'd like to ask.
Okay. If I had this list correct, from the things you said in the beginning, and just kind of a show of hands as to whether you think we covered it or in the Q&As we need to pick up some more information. One of the items was understanding role as a new board member. Did what we covered today help? Good, okay. Training and preparation, there's a lot. I mean, again, I'm going to say it's an ongoing process, and I think we just scratched the surface. I can't believe how much we actually covered in an hour and a half, an hour and 45 minutes. But, you know, we can add to the list, and maybe we can persuade Ed and Joel to do another session, more advanced. Community communications, shareholder communications were a couple of the issues that were raised. You think we need to talk a little bit more about that in the Q&As?
Yeah, could you sort of give your experience on what's to be communicated to the shareholders versus what's to be kept in on the board, and you know, that fine line?
I'm going to defer in a minute to Joel. I mean, legal issues, employment issues, things that are, you know, shareholder individual financial issues, to me, are all confidential. Right. Everything else, in my opinion, gets communicated. What I can give you some tips on some of the things that we've done. We started what we call an update, to the dismay sometimes of our attorneys. We send out, after every board meeting, it tends to be about 10-12 pages, a full communication of everything, including every question and answer that was raised in a board meeting.
Open only?
Open session, not closed, obviously. Every single session. What our shareholders here have said is, thank God they don't have to come to some of the meetings. The meetings have gotten shorter, and I don't care who it is in the elevator, they read it. They read it, they run into you, they say, I read the last update. It tells you everything that's voted on, every capital, every expense that's voted on, every issue that's raised in open session, every question, even if it's critical of the board, every question and answer gets put out there. We also, yes?
What about closed meetings?
Closed session, we have minutes, obviously. They're not open to the shareholder, but the closed session is primarily on issue that we use it in two ways. And I will defer to Joel when he answers some questions. We use it on confidential issues that are not open to the public. We also use it partially as a working session because one of the things, our board meetings would last 87 hours. If every presentation on every single item that we're going to vote on went through a full open session. We do, like, for example, if we're doing a major capital project, there could be an engineer discussion, there can be review of bids. Now, in the open session, we do go over the bids, how many bids, what the amount of the bids were, who it was awarded to. We do give the shareholders the information, but the Q&As and a lot of that gets done in working session before.
Just very briefly, there has been an effort in the legislature for many years to require that executive sessions be open to the membership. That has not happened yet. And so closed sessions can be kept closed, and there's no legal requirement that members of the public, members of the unit owners attend. In a closed session, as I mentioned earlier, unless it's a matter involving personnel or a confidential legal action that has to be taken, or a determination, a matter of confidentiality, no action should otherwise be taken in a closed session. They can discuss the matters, but the actions themselves have to be taken in a open session. As far as litigation is concerned, obviously the membership has a right to know what litigation is out there. I will say sometimes it's a little difficult to get into the specifics of the litigation at particular turns of the litigation when you're involved in negotiations, etc. But clearly, first of all, anything material has to be disclosed in the financial statement. But apart from that, at the appropriate time, the public, the membership, of course, should be informed.
Excuse me, are you saying that if a shareholder is delinquent, let's say, in their payment, and for whatever reason, and send notices and whatnot, and then you elect to sue that shareholder, that has to go to an open meeting?
No.
Oh.
No. I'm saying that that's a personal issue, a personal matter. In fact, sometimes an issue has been raised as to whether, because let's say shareholders in a co-op are absorbing the burden of those who are not paying the maintenance, so they should publish the list of those who are delinquent. We do not advocate that, because number one, if the shareholder had a defense or some claim, or there was a computation error on the part of the co-op and it went public, you'd have to notify your carrier right away. So in those particular cases, we do not counsel our clients to make public actions that are taken or who's delinquent at any particular period of time. I'm glad you mentioned that question.
I'm a little confused. If the board makes a decision to sign a contract with some guy to do the landscaping outside, can the board make that in an executive session? Or we, no?
The board sometimes can agree that this is what should be done and then formalize it later on in a public meeting. Sometimes there's a need for the board to act, and so they'll take action and then ratify it later on.
When you say ratify, just announce it to the shareholders? Or they have to
No,
vote
you
on
have
it?
an agenda for a public meeting.
Yeah.
As I mentioned earlier, you're supposed to post notice. What does that agenda consist of? If it's hiring a landscaper, then that should be listed on the agenda for action to be taken.
But the shareholder's not going to vote about it. This, we're going to announce it at an open meeting, correct?
It's a board decision.
Right.
But it
Just to be announced at an open
meeting.
meeting.
It provides, as you said, more information.
On that topic, it just hit came up today. So this is relevant to the sunshine provision of the Open Meetings Act?
Right.
Okay, so you want to renew hospitalization, you want to renew landscaping. We had a meeting today, we brought the vendor in. The date's November 1st. The vendor's proposal is fine. We haven't had an executive session board vote yet. We're going to schedule that for October 23rd. He made the presentation for the executive session. For the October 23rd meeting, we have to post to the unit owners that they can attend that vote session so that we can ratify our renewal.
Yes.
Do they have anything to say in that meeting?
No. It's an announcement.
What if you've recently done something major and didn't announce it publicly to the president? How would you go about it? And then it happened today, and already today we're going to complain.
I mean,
what do you recommend to the board?
I'd recommend to the board to take the action, even though late, ratify the action that it took. Yes.
One other question I had about what do condominiums usually do about, let's say, a holiday party or renting out a public common area for
serve bagels and lots
and alcohol consumption? Yeah. What is the board's liability, the association's liability to somebody leaving and getting in proximity?
There's always exposure. I mean,
do most condominiums try to prohibit alcohol consumption?
Look, there's liability. You operate a pool. There's liability. You just want to make sure that your coverage would apply to what you're doing. We had a situation where there was a suite, a sky lounge in one of the buildings, and they wanted they were hosting private parties, serving alcohol, etc., and the board was allowing them to do it. Well, that would implicate exposure. So they decided now to protect itself that they, on a go-forward basis, we're not going to permit alcohol on the premises.
But is there guidelines? Is it usually most condominiums don't allow alcohol consumption?
It varies. It varies. No, I don't want to call it.
As
No.
the question of retroactive ratifications.
Yes.
You know, that's happened quite often, I think, with every board where there's an emergency appropriation.
Absolutely.
That comes up. And then also the other question is the board is able to set a threshold too, correct? In other words, minor under X number of dollars typically don't have to go to
Yes.
the full board meeting.
If they took that action at a public meeting.
Right.
Yes. Yes, ma'am.
You said that the board should rely on counsel for advice. But how does counsel react when the board is putting pressure on them to take contrary action?
Have to get another attorney then. Happens all the time. And an attorney worth his salt or her salt has to give the best opinion possible and has to do it to protect himself or herself as well. Sometimes they don't like to hear what you have to say. Happens all the time. Anyway,
Two questions, Bill.
Marvin.
First one, can the lease say that the house rules can override the lease?
No.
Okay, that's the answer to the
No.
first one. Second question is, you mentioned open public meetings in Predfa. I was under the impression that the Open Public Meetings Act and Predfa are essentially the same.
Yes.
So one applies to local municipal governments and Predfa to real estate development.
Yeah, PRED applies, it's Planned Real Estate Development Act, establishes the requirement of open meetings, establishes the requirement that there be alternate dispute resolution. The same appears in the Condominium Act as well.
We promised everybody we'd get you out on time. The speakers will be here to answer any questions. Our contact information is up on the screen. So we thank you. Arlene, is there anything you want to do?
I just want to add to something in relation to the questions you were asking. We have like a pro forma kind of agenda. We know every month we're going to have certain contracts. We know every month we're going to have capital. If we don't, it obviously doesn't go on the agenda. We know every month we're going to have a treasurer's report. We know every month we're going to have certain committee reports. And what we do is we have a list of like all the contracts that are coming due for the next 3 years. They automatically go onto agendas. So you never miss doing it far enough in advance that you've covered yourself in terms of votes in open session. It's not just ratifying, you're taking an actual vote. You can discuss it in closed session, but you take the vote in open session.
Say it again.
You can discuss in closed session, you have to vote in open session. You have to physically vote. Yeah.
Okay, thank you all.
Thank you.
We get our information